some simple variables we can look at. And the first one is really inflation. When I look at inflation, that's the single, I think, most important variable that's going to give us an indication of what rates could or could not do is going to be what inflation is expected to do. And if there's inflation starts to move up, over and above 3-4%, when it was, if you look back at the chart on the left, you can see that in January 2023 it was coming down from 6. That's very bad inflation. So we increased rates 5% over that time frame, really stalled the marketplace and pushed pricing back down to something that's more acceptable at closer to 2%. But now that we're going through a slower bit of an economy, we still have the noise coming from the U.S. We're seeing inflation continue to reduce. And that's positive news, because if we see no upward pressure on inflation, that means there's no upward pressure from inflation on interest rates. And inflation is the number one factor to move rates up. So inversely, we're seeing inflation come down. It was expected to be 2.5 in January. It actually came in at 2.3. So it came in a little lower. It's projected to decrease to 1.75 in February and March, which is well below the 2% target. So I think that's positive for us. So if the other economic variables that we're going to look at move in the direction that supports a rate drop, inflation is already working with us and already being suppressed. So we could see a potential rate drop depending on what the other variables do.
Okay, thank you, Joe.